Here are three high growth tech stocks currently trading at the lowest valuations we've seen in a very long time. The first one is Amazon. With a PE ratio of 35, Amazon is currently trading cheaper than it was during the 2022 crash. At current prices, the forward PE is 31 and the 2-year forward PE is around 26. Amazon grew revenue by 11% year over year last quarter and EPS by over 90%. So that just shows us that if they want to decide to start focusing on profits, they can generate massive returns. I think Amazon is pretty much indestructible at this point, and they have so many fast growing businesses that will likely continue to grow for decades to come. So I continue to buy shares of Amazon. The second stock is Uber. With a PE ratio of just 16, it's trading at its lowest valuation since turning profitable. At current prices, the forward PE is just over 30 and the 2-year forward PE is just over 22. And that sort of valuation for a company that is growing revenue at 18% per year and EPS even faster at 430% last year. Obviously, the EPS growth rate will slow down, but for a company with so much operating leverage, I expect EPS to continue to outpace revenue growth nicely. Many investors think that Waymo and Tesla will take Uber out of business, but I think there will be enough autonomous vehicle providers that a handful of them will partner with Uber and take advantage of their huge network. And therefore, Uber will continue to thrive. And that's why I've been taking advantage of this dip and buying the company heavily recently. The third and final stock is Google. Google has been facing the most criticism recently, and therefore it has traded down to a PE ratio of just 20. That's almost as cheap as the stock was during the 2022 crash. At current prices, the forward PE is around 19 and the 2-year forward PE is just over 16. The revenue chart tells a different story than investors are telling right now. This is not a dying company. A company as massive as Google is still growing revenues at almost 14% per year, and EPS much faster at over 38% per year. And that's largely because the company has been taking advantage of these low valuations and buying back billions of dollars worth of shares. And Google recently started paying a dividend, which might put this one on the radars of dividend investors. I currently don't own any Google shares, but at these valuations, I'm gonna have to pick up some shares next week.